Good afternoon, ladies and gentlemen, and welcome to the AMINO Technologies investor presentation relating to the interim results for the 6 months ended 31st of May 2020. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd like to remind you that this presentation is also being recorded. Before I begin, I'd like to submit the following poll. I'd now like to hand over to Donald McGarver, CEO, and Mark Carlisle, CFO of AMINO Technologies. Good afternoon.
Good afternoon and welcome, and thanks for your time. We're delighted to take you through our investor presentation. So I'm going to run through a little bit and then I'll hand over to Mark. So I hope today, really 3 takeaways from this presentation. First, and probably most important, is that we basically announced 18 months ago that following, we would take a strategic transformation towards becoming a software-led company. And I'm pleased to say that is now complete and certainly well underway. And hopefully that some of the numbers and some of the evidence that we talk about today will support that conclusion. Secondly, we've been through really a repositioning of the company, along with the acquisition that we completed 12 months ago with 24i. We now are positioned in a growing part of the marketplace, and really addressing this growing area of the convergence between streaming services and traditional TV. And thirdly, I think we've got a very resilient business model, and that's been proven through COVID-19 and all the things that threw at us. So hopefully you'll see that not only have we got through that period strongly, but actually we're very focused and confident about meeting the expectations that are ahead of us for the remainder of the year. So the kind of highlights, I think the most important thing I'd like to highlight is we continue to win business. We've seen a strong pipeline, we've seen strong pipeline wins, and we've added a number of logos to our business in the period. Also, we're winning more business with some of our existing customers. That's always been the case, but it seems to have accelerated through COVID-19 in that customers looking to expand and grow, come to us to help them to deliver more of that solution for them. We're investing in our product and in our solutions, and I'll talk about that a bit later on, particularly our next generation platform, because they help us grow and help us generate more in recurring revenues. And overall revenues in the period for the group were up 10%. That all came from software. And software and services now represents 26% of our group revenues. And I'm pleased to say that recurring revenues also doubled in the period to $10 million. What we didn't say, and probably should have said, is that actually, the device business, and while slightly behind, prior year, again, we've seen that catch up. We've seen orders catch up as we moved into the second half. And again, we expect that to be at a similar level to the prior year as well, as we go through the remainder of the second half of this year. Obviously, the most important part of that growth story has been what we call 24i. And 24i, that was the acquisition we did 12 months ago, of which we merged our AMINO TV solution. And we've seen organic growth in that division actually about 30%, which is slightly ahead of where we anticipated. We always said we expected 20 to 25%. And I think helped by some of the success on the wins, but actually by customers asking us to do more with them. A good example of that is Broadway HD. It's a Netflix type service that delivers Broadway and West End productions. And obviously with COVID-19, that was probably one of the only destinations to go to get that kind of entertainment. And we saw massive increase, massive spikes from thousands of subscribers to hundreds of thousands of subscribers. And whilst we expect that some of that will taper back as people return to normal and the West End and Broadway goes back live, we think the majority of it will remain there. And we're still seeing that because people in Kansas and the west coast of America who can't necessarily get to all the Broadway shows, this has become a destination place to go to see these events. And we've helped that customer with things like watch parties, with Hugh Jackman hosting it, scaling, significantly. And we've helped that customer through our services and our solutions to be able to deliver those kind of events and to deliver that service. Another one's quite important to us and quite important to our customer, Ufone, a Dutch MVNO that delivers a broadband and also now a TV service. We delivered that in just over 4 months. And that service, a fairly complex service, end-to-end service, that you would expect normally that to be over 18 months in deployment. And that just shows you the sort of the nature of the integration we've done with our end-to-end service, combined with the scalability we have in that platform. And you'll see in some of the trade press, there was Ufone and ourselves made some announcements around that today, because that was the first Android TV service delivered in the Netherlands. Another one I think that's important to bring attention to, NPO, the Dutch national broadcaster, effectively for us, the BBC of the Netherlands. We provide all of their applications and their streaming services, a bit like the iPlayer is to the BBC. Again, we saw a massive increase when that service, during COVID-19. So in April, we saw a 35% increase in streaming starts. Much higher viewership. We've seen that continued, and we believe that people want to, receive the traditional broadcast through some of these new mediums, and that obviously plays well to the solutions that we offer to customers. And then, very important to us, we deployed the first instance of our next-gen platform at the T-Mobile company Slovak Telecom, and for us and for our customer, it gives them a much more scalable platform, and actually gives us a much stickier and higher recurring revenue basis of which to move forward. So we're moving all of our new customers onto that platform, and we will over time remove existing customers onto it as well. And in AMINO, our more traditional part of our business, again, the software and services there and our recurring revenues have continued to perform well. We have a platform, we have a SaaS-based platform called Engage. It's service management, the ability to manage, upgrade, analyze, and control devices remotely. And one of the things we noticed as we went into lockdown and we started to engage even more closely with our customers, we realized quite quickly that one of the issues customers had, operators in particular, was how could they get access to their customers' premises? How could they resolve issues? How could they install services when actually they were receiving more demand for those services, and how could they do that safely? So we did two things. One is our customers who already had that service, we actually engaged with them to provide some training and some education and some support to help them utilize that more effectively. And for those customers who didn't have it or weren't using it, we actually offered them then free of charge for a period during COVID-19. And I think two things happened there. One is the customers obviously saw the value in that. Secondly, customers appreciated that rather than trying to sell and ram things down their throat, we were actually there working with them and supporting them through what was a difficult time. And it just showed the value that AMINO and its various solutions can actually bring to bear its customers. In addition, during that period, we've taken our what we call our Pay TV Plus platform, and we've moved that forward. So another few integrations that we concluded in the period. We were Google certified. We've taken that to the next level. In addition, we added Amazon Prime, we added Netflix and Disney Plus, and we now see our Android TV across 5 operators globally. We've got Netflix deployed on three of those operators, and a number of them deploying some of the other services we've got there. And then one of our other offerings, which we've had for some time and is a bit unique, is our upcycling, the ability to extend the life and the return on investment that people have made in their devices and their infrastructure. And working with one of our European operators, we're able to take our software, deploy that across their platform, allow them to reuse a lot of their infrastructure that's there, which saves them a capex of about $5 million, and make sure that we are the platform of choice for them going forward as well. And I think that's really important to note is we, as I said, we have really positioned Amino in a different part of the marketplace with a different approach to the marketplace. Traditionally, we've serviced operators. Today, we service operators, broadcasters, media companies, and content owners. And we do that leading with our user experience, with a new user experience, with new applications, allowing them to deliver that anywhere, anytime. And we see that consumers, how they discover, access, view, and interact is almost as important as the content itself today. And they will choose platforms and operators that give them that choice and that convenience. And that's what we lead with. As part of looking at, what we're doing and the future and our solutions, we did a bit of an exercise to really take a fresh look at our marketplace. And not just look at what the demands of our current customers and future customers were, but look at what the demands of consumers were. So how are consumers looking to get their content over the next 3 to 5 years? And we really looked at, why we do things, how we do things, and what we do. And when we looked at our purpose, why do we exist as a group, as a business, as an entity? We see that we're there to make it easy for people to connect with the TV and the video they love, and to do that anywhere, anytime, and using any device. How we do that is taking away complexity for our customers, the operators, the broadcasters, and the content owners, allowing their customers the choice and the convenience that they want in the service. And finally, what do? We provide a smarter, more cost-effective way of delivering a modern video experience, and doing that in a way that fits with our customers' needs. And out of that, we also saw a lot of interest in data and market research, threw up some interesting points. And I think out of that, clearly streaming services, and the acceleration that we've seen over the last 6 months are a much more important part of the service that the consumer wants to receive. However, they want to get that conveniently, having that through their service provider or managed through a platform or a service provider. And the conclusion that we came to is they actually want the best of both worlds. So when you look at streamers, there is some data out there that says streamers spend up to 20% of their time actually trying to find and discover the content that they want to watch. And they want to receive that content in a way that fits with like a traditional TV service. So it's easy to access, easy to find, and easy to discover. But if you're a pay TV operator, a pay TV subscriber, you also want to get access to all of your content through all of your streaming services and get that in one place. So again, we see that consumers want the best of both worlds. And so what we've done is we've really aligned our service offerings and our go-to-market offerings around these core kind of principles that consumers and our customers want. We lead with what we call multi-screen video, the ability to deliver to any device, anywhere, and to do that with the kind of experience that a consumer would like to have, been able to discover, to be able to find their content, and to do that easily in a way that fits with how they live their life. And that we offer to all of our customers. We've then got a set of offerings built around more the operator space and the broadcaster space, what we call Pay TV Plus. The ability to to extend their capabilities by offering, a lot of these new streaming services as part of that platform. And again, being able to deliver that to any device. And then finally, to appeal to the CFOs and the more money conscious, and because a lot of operators today, they've made significant investment in the platforms. They're not able to suddenly transfer that over to the newest exciting thing that's out there with all the features. And they want to extend the return on that investment. We offer what we call through upcycling, some services and some solutions, software-led solutions to actually prolong the life of those devices and make sure they have a platform that has the right experience for their customers. And what I really wanted to kind of demonstrate here is if you look at the supply chain for provisioning, play out through delivery and consumption of content and video, you see there's certain elements in there that I show here in this slide. And what I wanted to demonstrate is just below that, the kind of offerings that we in Amino have in that. And hopefully you can see from that, all of our offerings now today have a software element. And most of our offerings today are a recurring license fee and maintenance with some professional services. The only real exception to that is what we call AMINO View. That is our devices, which are still very much transactional. But even in those, we license our software, we support that software, and we maintain that software on a license and a recurring basis. So I'll now hand over to Mark, and I'll let him take you through some of the numbers.
Thanks, Donald. So just everybody to orient yourselves around the financial highlights. This slide's showing that our total revenue for the half was up 10% year on year to 38 million. And within that, software and services at 9.7 million, now 26% of our business. And we have an annualized run rate recurring revenue at the end of May, which we calculate at 10.1 million. And I'll take you through a bit more detail of that in a second. Our adjusted gross profit margin is now up to 50%. And that's directly as a result of the acquisition of 24i, which has a gross margin of about 78%. And the AMINO division has a gross margin of about 42%, which it's maintained this period. We generate cash, and our adjusted operating cash flow at 4.8 million. I'll take you through the cash flow in a minute. Has been impacted by timing of some customer payments we had in the previous year in advance that didn't recur in this period. So I've just realised I'm in charge of these slides. So when we do other investor presentations, Donald does it for me.
Normally it's on the slides.
Sorry, Donald. Here we go. Professional. So in terms of our quality of revenues, what we've set out here on the left-hand side is our segment revenue. We have two segments in the business. One, the 24i division. And as Donald mentioned, this time, or the first half last year, that 24i division really comprised what was then termed our AMINO TV business. We merged that in with the 24i business that we bought in July 2019 in the second half. So what you're seeing here is the impact of that acquisition of 24i and growth in revenues from 1.7 to 7.7 million in the half. When we look at that on a pro forma basis, organically, we see that the 24i segment grew organically by 30% year on year. In the AMINO division this year, we saw a decline in revenues of 10% from 33 to 30 million. As Donald also mentioned earlier, that was mainly due to some orders from some certain customers pushing from Q2 into Q4, mainly due to COVID related. I'm pleased to report that all orders we did receive in H1, we did fulfill from the AMINO business, despite the disruption we saw to the supply chain in China in February. So that was a really good result. What we're seeing in the second half is that we expect that slight budgetary miss to catch up, and we're forecasting those orders to catch up, and therefore the AMINO division we're forecasting to be flat year on year. In terms of our software revenues overall, the overall software revenues from both divisions, when you combine them together, grew organically by 24% and now represents 26% of our total revenues. This time last year, that was 10%. So we are achieving our strategic goal of driving our software and services revenues forward. As I mentioned, our annualized recurring revenue was 10 million at 31st of May, and that comprises our license, maintenance and support revenue on the software we sell. The remaining software and services revenue that's not classified as annualized run rate recurring, as you saw in the previous slide, is from our professional services. And indeed, some of that is contracted over more than one period, but we consider that analysts' definition does not include that in run rate recurring revenue. Moving on to our revenue by geography, what we can see on the left-hand side is that the majority of our revenues continue to be in our largest regions in Europe and in North America. And in particular in Europe, we're very strong in the Netherlands region, as you'll see from our more detailed results in my CFO report. We've seen good growth in Europe as we've seen some rollouts of new services at existing customers and in 24i wins from new customers, particularly in the Netherlands. In North America, although the 24i division has continued to win and we've seen good upsides from existing customers in terms of volumes that Donald mentioned earlier, particularly from Broadway HD. In the device business, we've seen some destocking through our distribution channel, which has had a short-term impact on the H1 results there, and we have seen that already catch up in H2. We have seen a small device market decline, in North America as well. And overall, that is small, but we do expect that to continue. In terms of the revenue by type, we set out a revenue by type again on the slide on the right-hand side. And this just reminds me to sort of explain to you that, as Donald mentioned, we sell all our devices bundled with our AMINO OS software. So even though the 74% of our revenue is sold on a one-off basis from devices, that one-off is a bundled fee of the hardware we sell, but also the AMINO OS software that we bundle with that and integrate with our customers' video ecosystem. Moving on to the income statement, you can see the impact on the top line of that increase in revenue growth from 34 to 38% as we've increased our software and services revenue. You can see the impact of the gross profit margin increase from 45 to 50%. The increase in operating costs is directly as a result of the acquisition of 24i, and we've maintained our EBITDA margins at 19%. We have had an impact of the transition to IFRS 16, where we've seen 0.6 million of costs effectively be reclassified from operating costs into depreciation and amortization. On a like-for-like basis, the depreciation and amortization this year would therefore have been 2.4 million versus 2.2 million last year. And the decrease in adjusted operating profit really is due to two things. One, the timing of those device revenues in the AMINO business, which we have increased the profitability of this year versus last year overall, but also the investment in the 24i next-gen platform, which we're investing in to scale our recurring revenues faster in the future. We had some exceptional items in the period. We continued to renegotiate royalty costs from previous years, 0.2 million income from releasing those accruals. We also have some expense to contingent consideration from the acquisition of 24i, where the founders continue to receive payments from on a deferred basis. We paid 1.1 million in July this year, and the final 1.1 million deferred consideration is payable next July. We had interest costs in the period of $200,000, and we anticipate that will reduce, and you'll see the impact of the increase in our cash and decrease in our gross debt on the next slide. So moving on to the cash flow, you can see that the adjusted operating cash flow was impacted really by the timing of customer payments, and we also paid corporation tax of 0.6 million in the period, which reflects the current tax charge of last year. We do capitalise R&D, and the majority of that, 2/3 of that, is for investment in the next-gen platform in the 24i business, and 1/3 is in the AMINO product development. And that CapEx is 2.6 versus the depreciation amortization I mentioned earlier, excluding the IFRS 16 operating cost of 2.4 million. You can see that we repaid borrowings of 5.2 million in the period. We had gross borrowings at the previous year end in November of about 7.5 million, and we currently have borrowings with Barclays of 2.5, and we expect that to be paid off in Q4 as we continue to generate cash. We now have net cash at the period of 2.2, and it's worth noting that we also continue to have our working capital facilities with Barclays, $15 million, which runs to November 2022.
Okay, hopefully I'm unmuted now. So I just wanted to highlight here just some of the investment we've made in our R&D and some of our products and some of our solutions. I mean, in the period, obviously, we continue to invest in Android TV. I talked about the Uphone deployment we had in the Netherlands. We've actually deployed across five other customers. If you look at AMINO OS, we continue to add features, we add services. We integrated Netflix. We're actually a Netflix partner, particularly in Asia, Pacific, and Europe. We added Amazon Prime Video and Disney Plus, and we continue to add other services as these become, things that are in demand by our customers. Smart Video, our end-to-end platform. Again, we deployed that in the Netherlands. We also had our first deployment outside of EMEA with Topic in New York, in New Media. And if any of you saw our Capital Markets Day, you may be familiar with that. And then finally, as we said, investment in the next gen platform, allowing us to gain more recurring revenues in the future, but also to give a much more scalable platform for our customers that allows them to deploy new video experiences much more quickly and much, much easier. And the first one we deployed was with T-Mobile at Slovak Telecom, and all new customers now moving forward on that platform. COVID-19, I think our approach was, we actually went into lockdown a little bit, or went into remote working a little bit earlier than most. We did have a bit of a canary in the coal mine in that our office in Hong Kong had already experienced this at the end of January and into February. So we kind of knew what was coming, and we took that opportunity to, whilst the offices were still open, is to move everybody remotely. And that allowed us to move a little bit more seamlessly, so that by the time that official lockdowns came, we were all on the front foot and actually engaged with our customers. The approach we took was to focus on our employees, look after them, make sure they were safe and they were working constructively and productively, and therefore they looked after the customers, and the customers therefore looked after the business. So we really engaged quite early on upping our customer service, putting in place customer success teams, engaging more actively, our social media presence and our marketing. We upped our game a little bit, and all of us at a senior level, using our relationships with our customers to make sure we were reaching out to find out what we could do to help them and support them. And I think that paid off. And I talked about some of the initiatives we have about providing services and solutions, free of charge, whilst we helped our customers through that. And that certainly seems to have been appreciated by all of them. So our strategic priorities, they remain the same. We want to expand our addressable market. We're investing in our solutions, investing in our technologies. We do believe there's opportunity for some M&A, and that will accelerate as there's a bit of consolidation in the marketplace. And obviously, with us being much stronger, hopefully in a good place to do those where those make sense. We aim to grow our margins by focusing on our high growth software and services, and still maintaining that sort of strong cash generation that we see through the AMINO business, which is through the devices, which not only is cash generative, it's also very complementary to the rest of the business and part of our overall end-to-end proposition that helps differentiate us. So summary, I think it's been a good period for us. It's been challenging, but I think we came through that with a very resilient business model. We're quite optimistic about the remainder of the year. I'm sure there's going to be other challenges around COVID, but I think as we've shown in the first half, we can certainly deal with those and some. So we believe that we have a good period ahead of us. We're very confident about meeting our expectations in the second half, and that is already well underway. So that was really all from us.
Thank you. Thank you, Donald. Thank you, Mark. Ladies and gentlemen, please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review investor questions submitted today, I'd like to remind you that a copy of the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your IMC dashboard. And lastly, before we hand back to the Q&A, I'd like to remind you that your feedback is important to the company. Immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Mark, Donald, I know we had a few questions that were pre-submitted, so perhaps if we could look to address those first, and then we'll turn to those questions that have come in during the event itself, if that's okay with you guys.
That's fine.
Perfect. The first question we had was, what are your typical sales cycles when it comes to winning new business, and what do you think gives you ultimately a competitive advantage?
Typical sales cycles are probably 9 to 18 months. Obviously some shorter than that, but really it depends on the client themselves and a bit on the complexity of the solution. But what we actually have found is that, I talked about Ufone. I mean, that was a good example. That was a very short sales cycle. They had a need, they had a change in their circumstances, and we were able to bring a fully end-to-end solution to them in a very short period and deploy that in just over 4 months. We would have expected that to be an 18-month deployment historically, but the fact that we've now integrated these features and our video experience platform includes a pre-integrated set of devices, so we can be up and running in a very short space for our customers.
Perfect, thank you. Next question is, do you see possible growth opportunities through acquisitions or predominantly through organic growth? And are there any potential areas of interest you would like to expand into?
We do. I mean, our focus is on organic growth, and you can see we've done quite well on that, and we believe that will continue at 20-25% in the software business. But we do see opportunities for M&A. There is a bit of consolidation, as I mentioned, in the industry. We see some, technology gaps that maybe we could either strengthen, add some services or solutions that we could probably bring into play there. We see opportunities to scale the business and get more traction with customers. So those are the kind of areas we target. Obviously, we've done M&A, as you're aware, and we closely look at that. So we do have a pipeline that we kind of manage to make sure that if the right opportunity comes up, and if we can do that it's got the right dynamics about it and the right valuations, then that's something we'd look to do, obviously with support of our shareholders.
Thank you. I guess we've got a question that's come in the live event from Graham, who asks, when do you hope to restart dividend payments? And you've also had a pre-submitted question, what is the situation regarding the dividend? So perhaps I can give you those two at the same time.
Yep. Well, I think probably as everybody's aware, the board took the decision to suspend the dividend at the beginning, when we were into the serious situation with COVID-19, and that really was the prudent thing to do at that time, just to make sure we had a robust balance sheet. Again, we've been very resilient through this period, and we expect things to be strong in the second half. So we recognise there is a need for a lot of shareholders, and I know a lot of shareholders do value the dividend. So we will consider all options to make sure we meet those requirements. But we've really decided the appropriate time to consider a final dividend for 2020 will probably be following the period end, and that's when we'll have a clearer picture of trading in H2, which we're optimistic about, and also any impact of the pandemic in the future of the business. But again, we will take that after H2, and I think we're quite optimistic about and confident about how that is now going to proceed.
Brilliant, thank you. Well, that concludes the three questions that I guess that were pre-submitted. Perhaps I could just draw your attention to the questions that have come in during the live event. Obviously, if I could ask you to read out the question and then perhaps give your response, and then I'll pick up from you at the appropriate time.
So we had one there regards to M&A and what areas are looking to target. Hopefully I've answered that one. It is very much about technology. It's very much about expanding our customer base. What else have we got? Major competitors. So Peter C asked, who are your major competitors and what do you estimate as your current market share in devices and software? We don't really have a lot in market share in devices and software. We do have some information probably in different segments. I mean, I certainly know if we look at the sort of tier 2, tier 3 marketplace in North America with our devices, our market share is certainly above 50%, and is very strong in that area. Our major competitors, they vary by solution, but I think we are a little bit unique. And sorry, I'm maybe answering one of the other questions earlier about our competitive advantage. One of those is the nature of our end-to-end platform, that not only can we provide the whole solution from the user experience right through to CDN and all the other aspects of it, but we can also have a set of pre-integrated devices, so that helps us in terms of time to implementation. We do compete against people like Excedo, people like U.I, that people may have heard of in the kind of the sort of application side of the business. And then in devices, there's a number of those out there, people like ADB, people like K-On, who are Korean, and then on a much larger scale, people like Technicolor as well. But our focus is where our hardware adds value, and we deliver it pre-integrated so that it's very much plug and play for our customers. So that was, we 2 years ago we took the decision to move away from sort of commodity sort of high volume hardware, where we felt that wasn't an area we really compete. We wanted to be able to add value to customers where they wanted that fully integrated solution.
Thank you. I think looking at what's come in, you've probably taken on all the questions that have been submitted during the event. I think you've double crossed them with the ones that were pre-submitted as well. So I think you were lucky, the commonality in the questions. So I don't know whether, I think there's just one that's just come in. I don't know whether that is addressable at this particular point. We've got time.
No, a good one there. To what extent does the development of services like Amazon Prime and Apple TV represent an opportunity as opposed to a threat? Very much for us, we see it as an opportunity. Our goal is really to deal with this convergence from traditional TV and streaming service. So if you look at it, we're working with, particularly with Amazon, Netflix and Disney, to actually integrate those so that, operators can provide that as part of their overall service, and so that consumers can get easily access those through formats they're familiar with. So we continue to work with these. We have partnerships with the people I mentioned, so that we can integrate those and offer those as part of the overall service.
Thank you. I think there's just one question that's also just come in. I don't know whether that's probably just scroll up a little bit. You'll see it pops in.
Yeah, no, I can take that one. So the question is, adjusted profits it's from Andy E. Adjusted profits are often unavoidable, but there is a significant gap between adjusted and statutory numbers this time. Will that extend into the second half? Thanks, Andy. So the question about adjusted profits is the adjusted profits that we look at are really what we drive the business to operationally. The items below adjusted profits tend to come from mergers and acquisitions and other items that are not something that the management team drive operationally. As the business goes into the second half, you'll see from the progressive and the FinCap notes that the business is forecast to be more profitable in the second half than the first half. So that gap will that gap will be better in the second half than it will be in the first half. So it won't get worse. It's at that point it will get better.
Thank you. Well, I think you have addressed now. I'm sure that if any other questions do come in post this point, obviously, I know that you can review these, and obviously we will publish responses where it's appropriate to do so and send those to all the investors attending. Donald, perhaps I could just hand back to you, I guess, just to wrap up, and then obviously I'll redirect investors, as I know feedback's important to you guys.
No, thank you very much. I hope, as I said at the start, the 3 points I want to leave you with is, one, we've made that transition to software-led business. Secondly, we're now positioned in a really exciting part of the marketplace, that convergence of streaming services with traditional pay TV. And thirdly, resilient business model that saw us well through the first half of the year. And we're confident we'll see us through the second half and on. We think the trends are good for us, and COVID's just accelerated a lot of those. So, pretty upbeat, pretty optimistic, and looking forward to growing the business. So
brilliant. Brilliant. Thank you, Donald. Mark, thank you very much indeed, and thank you for updating investors today. Could I ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback. If you access this platform, this website from our website, the feedback page will appear. If you access the link in the email, you'll be asked to simply just log back in to submit your feedback. So on behalf of AMINO Technologies and Investor Meet Company, I'd like to thank you for attending today's session. Thank you very much indeed. Good evening.